Okay, so you guys send over a bunch of questions about investing. Sounds like you're ready to like ditch those get-rich-quick
That's a
schemes.
smart move.
Yeah, and you want to build some like real wealth.
Absolutely.
I get it. So today we're diving into the world of Benjamin Graham.
Ah, yes. The OG of value investing.
Right. And his book, The Intelligent Investor,
Yeah,
it's like, I don't know, it's like the Bible
it is.
for people who want to invest
Yeah,
without taking like crazy risks.
exactly.
What's the big takeaway from this book? Like if I'm just,
Yeah.
kind of dipping my toes into this, what's the big thing?
I think the big takeaway is that Graham was all about looking past the hype
Okay.
and focusing on what a company is truly worth.
Okay.
And this can apply to anything in life, but especially investing.
Okay.
It's like finding a hidden gem at a flea market.
Okay.
So something valuable that everybody else is overlooking.
I like that. So how do we even know what a company is actually worth?
That is the million-dollar question. Right. It's not like a sticker price.
Right. Yeah.
Like at the grocery store.
Well, it's where it gets fun.
Okay.
Because Graham, he kind of teaches us to become financial detectives,
Okay.
right?
I like it.
We have to investigate. We have to look at the company's finances,
Yeah.
their earnings, their assets, like all the nuts and bolts.
Okay.
He calls this intrinsic value.
Okay.
And it's what sets investing apart from just gambling.
Oh, okay. So less hot stock tips you hear from, I don't know,
Exactly.
like on the internet,
Yeah.
and more about understanding the business.
100%. Those hot stock tips, that's speculation.
Okay.
That's hoping to get rich quick without doing any of the work.
Okay.
Graham emphasizes that investing is about research and patience.
Okay.
It's about finding those companies that are solid and that are undervalued.
Right. Starting to see the difference here. But the market can be so unpredictable. Like, how do I protect myself?
Yeah.
If things don't go as planned, that's where this beautiful idea comes in that he talks about called margin of safety.
Ooh, margin of safety. Sounds intriguing. What is that?
Yeah. This is one of the biggest ideas
Okay.
that he talks about in the book. It essentially means not paying full price for something,
well.
even if you think it's a great deal.
Okay.
Let's say you go back to that flea market.
Yes.
And you find that amazing vintage jacket.
Okay.
And you think, I think this is worth $100. You offer 75.
Okay.
So that if you later find out it's not as valuable as you thought, you haven't lost as much.
That's smart. But how do we apply this idea to investing?
You buy stocks for less than what you think they're really worth.
Okay.
And that difference, that discount, is your margin of safety. It protects you
Okay.
from losing money if your calculations are wrong or if the market takes, a dip.
Okay. So margin of safety, all about being cautious,
Yeah.
kind of like having a little bit of it
Yes, a little buffer.
a buffer.
Yeah. A cushion.
Okay, I like it. So how does like a regular person actually put all of this into practice?
So Graham outlines two main approaches
Okay.
in the book.
Okay.
And he calls the first one the defensive investor.
Okay.
And this is someone who wants to grow their money steadily over time
Okay.
without a lot of fuss.
Got it.
And then you have the enterprising investor.
Okay.
And this is someone who's willing to put in a little bit more effort
Okay.
or research to find those, bigger returns.
Okay. I kind of like the sound of enterprising,
Yeah.
but maybe we should start with defensive.
Yeah.
What does that look like in real life?
Yeah. So the defensive investor would create a simple portfolio
Okay.
that's spread out
Mm.
over different types of investments like stocks and bonds.
Right here.
And then this is key. They resist the urge to constantly check the prices
Okay.
or make changes based on every little market swing.
So no obsessively refreshing the stock ticker
No.
every 5 seconds.
No. The defensive investor is all about long-term thinking and letting their investments grow over time.
Okay.
They're in it for the marathon, not the sprint.
Got it. What about those of us who are a little bit more, adventurous?
Yeah.
Tell me more about that enterprising investor.
So the enterprising investor is willing to roll up their sleeves, really dig into those company financials. They're looking for the hidden gems,
Okay.
the companies that the market is undervaluing. But even then, they're still sticking to Graham's principles. Thorough research, a focus on value, and maintaining that margin of safety.
Okay. So no matter which approach you take, sounds like you've got to be really smart about reading those financial statements.
Yes.
But honestly, those things can look like a foreign language to me.
They can?
Like, how do we avoid getting tricked by those,
Yeah.
like accounting shenanigans that some companies use to make their earnings look better than they actually are?
That's a great question. And that's where those, detective skills really come in handy.
Okay.
Right. One common trick is messing with depreciation methods. So basically, a company can make its earnings look better on paper,
Okay.
depending on how it chooses to account for the decline in value of its assets over time.
So it's like putting a filter on your selfie
Exactly.
to make it look better.
Yes, exactly.
Okay.
Graham was a master at seeing through these sorts of illusions.
Okay.
Right. Getting to the true financial picture of a company.
So he was like a financial Sherlock Holmes.
You could say that.
Okay. But how do we, learn to spot those clues?
It takes practice. It takes some knowledge. He gives you the tools
Okay.
in the book
Okay.
to break down those financial statements and see what's really going on.
Okay. Starting to see the light. But let's get to the fun part. Picking stocks. What are some of, Graham's secrets for choosing winners?
So he believed in focusing on companies with solid financials,
Okay.
right? The kind you could trust with your grandma's savings. Things like low debt, consistent earnings, and a history of paying dividends.
So no risky startups or companies that are, all flash and no substance.
Exactly. He warned against chasing what he called glamour stocks.
Okay.
With, sky-high prices.
Okay.
He reminds us that we're buying a piece of a business, not just a ticker symbol.
This is such a good reminder because it's so easy to, get swept up in the hype.
Absolutely.
But if we're really in it for the long haul, we need to focus on value.
Exactly.
Not just
Yes.
What's trending.
100%. And that's a great segue into one of his other key concepts, and that's thinking like a business owner.
Ooh, I like that. Tell me more.
Yeah, so instead of seeing stocks as just, pieces of paper that go up and down in price,
Okay.
Graham wanted us to see them as ownership in real businesses.
Oh, so if I buy a share of, let's say, a coffee company,
Yeah.
I should think of myself as a part owner of that company.
Exactly. And that means you need to understand how the business works, who their customers are, what their competition looks like, how they make money.
Wow. That's making me rethink how I think about investing.
Yeah.
Because it's not just numbers on a screen.
Exactly.
It's like a real business.
It is. It is. And it does take time.
It does. And that's why one of his most important pieces of advice is to be patient.
Yes. Patience, patience, patience.
I feel like we've talked about patience,
Yeah.
but I'm sensing that this is really
It is at the heart of his approach.
at the heart of it. Okay.
He saw the stock market as like a battlefield where emotions often lead to really bad decisions.
Okay.
When others are panicking and selling, the patient investor sees opportunity.
It's almost like having a superpower.
It is. It
The
is.
power of calmness and perspective.
It is. You could say that. And this leads us to another, important concept, understanding how psychology plays a role in investing.
I'm all ears. This is fascinating.
Okay. So Graham believed that human emotions, fear, and greed especially, were the biggest drivers of the market swings.
Okay.
He even created this character called Mr. Market to illustrate this point.
Okay, who's Mr. Market?
Okay. So imagine Mr. Market as this really emotional dude
Okay.
who shows up at your door every day
Okay.
offering to buy or sell your stocks at these crazy prices.
Okay.
Sometimes he's euphoric, sometimes he's depressed. The key is to not let his mood swings influence your decisions.
So Mr. Market is basically like that friend who's always trying to get you to buy into the latest craze.
Yes.
Even if you know it's a bad idea.
Yes. 100%.
Okay.
And just like with that friend, you need to have the strength to walk away when his offer doesn't make sense for you.
Okay.
Do your research, know what your investments are really worth, and only trade when it aligns with your long-term goals.
Okay. I am loving this Mr. Market analogy.
Yeah.
So stay calm, do your homework, and don't let Mr. Market's craziness get to you.
You got it. And that's a perfect example of how Graham combined financial knowledge with an understanding of human psychology.
This is incredible. I'm already feeling more confident and empowered to, make smarter investment decisions.
That's great to hear.
Yeah.
And remember, it's a journey. Nobody becomes an intelligent investor overnight.
Totally. So tell me, what are some of the biggest mistakes people make when they first start investing?
Oh.
What should we be watching out for?
One of the biggest pitfalls is getting caught up in the hype, chasing those hot stocks that everyone's talking about. Remember, Graham was all about value, not excitement.
Yeah, it's so tempting to jump on those bandwagons,
It is.
especially when you see other people making quick profits. But I guess that's where that whole, like, fear of missing out thing comes in, right?
Exactly. FOMO can be a powerful emotion, but it can also lead to some really bad investment decisions.
So how do we resist those tempting sirens of the market?
By sticking to our plan and remembering our goals, why are we investing in the first place? Is it for retirement, for a down payment on a house, or just to grow our wealth over time? Keeping those goals in mind can help us stay focused and avoid getting sidetracked.
That's such a good point. It's so easy to get lost in the day-to-day ups and downs of the market. But if we remember why we're investing in the first place, it can help us stay grounded.
Absolutely. And another common mistake is not understanding the risks involved. Every investment carries some level of risk, and it's important to know what those risks are before you put your money down.
Okay, this makes sense. But how do we even begin to understand risk? It seems so complicated.
Well, Graham talked about two main types of risk: business risk and market risk. Business risk is specific to a particular company or industry. For example, if you invest in a company that makes flip phones, there's a risk that their business might suffer as smartphones become more popular.
Okay, so that's the risk that a company might not be able to keep up with the times or that their products might become obsolete.
Thought.
What about market risk?
Market risk is the risk that the entire stock market might decline, even if the individual companies you've invested in are doing well. It's like the tide going out, even the best boats can get stranded.
So even if you've picked great companies, you could still lose money if the overall market takes a hit.
That's right, and that's why diversification is so important.
That. Don't put all your eggs in one basket.
Yeah.
Advice. We touched on that earlier, but I'd love to hear more about why diversification is so crucial.
Well, by spreading your investments across different companies, industries, and asset classes, you're reducing the impact of any single investment going bad. It's like having a safety net for your portfolio. If one stock takes a tumble, the others can help to cushion the fall.
So diversification is all about balancing things out and not putting all our hopes on one single stock.
Exactly. It's about managing risk and creating a more stable portfolio. But even with a well-diversified portfolio, we need to remember that patience is key.
I am starting to see a theme here. Patience seems to be like the secret sauce of successful investing, according to Graham.
It really is. Graham saw the stock market as a place where emotions run high, and those who can stay calm and rational often come out ahead.
So instead of getting caught up in those short-term swings, we need to think long-term and ride out the storms.
Exactly. The stock market is like an ocean with waves constantly crashing and receding. But if you focus on the horizon on your long-term goals, you're less likely to get swept away by those waves.
Okay, this is a powerful analogy. I'm starting to see the stock market in a whole new light. But even if we're in it for the long haul, how do we know when it's the right time to buy or sell?
That's the million-dollar question, isn't it? It's one that Graham had some strong opinions about. He was highly skeptical of anyone who claimed to be able to time the market perfectly.
So those market gurus who say they know what's going to happen next are probably just blowing smoke.
In most cases, yes. Graham believed that trying to time the market was a fool's errand.
So what's the alternative? Do we just sit on the sidelines and wait for the perfect moment, which may never come?
Not at all. Graham advocated for a more disciplined approach. He believed in identifying undervalued companies and investing in them for the long term, regardless of short-term market fluctuations.
So it's back to that idea of tuning out the noise and focusing on the fundamentals.
Precisely, he believed that over time, the market would recognize the true value of those undervalued companies and patient investors would be rewarded.
This is so helpful. It's like having a roadmap for navigating the ups and downs of the market.
It is. And speaking of roadmaps, Graham had some insightful thoughts on the importance of developing a clear investment plan.
Oh, I like the sound of that. Tell me more.
Well, Graham believed that before you even think about buying a single stock, you need to sit down and define your investment goals, your risk tolerance, and your time horizon.
So it's like planning a trip. We need to know where we're going, how much risk we're willing to take, and how long it will take us to get there.
That's a great analogy. He believed that having a written plan would help investors stay focused, disciplined, and avoid making impulsive decisions.
This is so important. It's like having a compass to guide us through the sometimes confusing world of investing.
It is. And speaking of compasses, Graham had some insightful thoughts on the importance of using financial statements as a guide for making investment decisions.
Okay, we've talked about financial statements before, but I'm ready for a deeper dive. What were some of the key things that Graham looked for when analyzing a company's financials?
Well, he was particularly interested in a company's balance sheet, its income statement, and its cash flow statement. He saw these statements as providing a window into the financial health and performance of a business.
Okay, break those down for me. What kind of insights can we glean from each of these statements?
The balance sheet provides a snapshot of a company's assets, liabilities, and shareholder equity at a specific point in time. Graham used the balance sheet to assess a company's financial strength and stability.
So it's like a financial x-ray showing us the bones of a company.
Yeah, that's a great way to put it. The income statement, on the other hand, shows a company's revenues and expenses over a period of time, typically a quarter or a year. Graham used the income statement to assess a company's profitability and its ability to generate earnings.
So it's like a financial report card showing us how well a company has been performing.
Exactly. And the cash flow statement shows how much cash a company has generated and used during a specific period. Graham saw the cash flow statement as particularly important because it provided insights into a company's ability to generate cash from its operations, invest in its growth, and pay dividends to shareholders.
So it's like a financial plumbing system showing us how cash is flowing in and out of a company.
You could say that Graham believed that by carefully analyzing these three statements, investors could gain a comprehensive understanding of a company's financial position and its potential for future growth.
This is so helpful. It's like having a secret decoder ring for deciphering the language of finance. But even with all this knowledge, it's easy to get caught up in the excitement of the market. How do we avoid letting our emotions cloud our judgment?
That's a great question, and it's where Graham's concept of Mr. Market comes into play.
Ah, yes, Mr. Market, that emotional fellow who's always trying to sway our decisions.
Exactly. Graham reminded us that Mr. Market's moods are constantly changing, and his prices don't always reflect the true value of a business.
So we need to stay grounded and not let his craziness get to us. But how do we do that in practice?
One helpful technique is to focus on the facts and the fundamentals instead of getting swept up in rumors or market hype. Stick to analyzing a company's financial statements and evaluating its long-term prospects.
So it's like being a detective separating the evidence from the speculation.
Exactly. Another helpful strategy is to have a predefined investment plan and stick to it. This can help you avoid making impulsive decisions based on Mr. Market's mood swings.
That makes a lot of sense. It's like having a script to follow so we don't get caught off guard by Mr. Market unpredictable behavior.
Precisely. And remember, Graham believed that by understanding Mr. Market's nature and by being patient and disciplined, investors could turn his emotional swings to their advantage.
This is so empowering. It's like learning to play chess with Mr. Market, anticipating his moves and using them to our benefit. But sometimes, even with all the preparation in the world, things don't go as planned. What did Graham have to say about handling those inevitable losses that come with investing?
That's a great question. Graham was very realistic about the fact that no investor can win all the time. He believed that losses were an inevitable part of the game, and he encouraged investors to view them as learning opportunities.
So instead of getting discouraged when we make a mistake, we should try to learn from it and move on.
Exactly. He believed that analyzing our losses and understand why they happened could make us better investors in the long run.
That's so helpful. It's like remembering that even the best athletes sometimes strike out or miss a shot. It's all part of the process.
It is. And speaking of processes, Graham had some specific advice for selecting stocks.
Okay, let's talk stock picking. I'm eager to hear more about Graham's approach.
Well, he believed in looking for companies with a solid track record of earnings and a history of paying dividends.
So we're talking about companies that are not only profitable, but also generous with their profits.
Exactly. He saw a consistent dividend history as a sign of financial strength and a management team that was aligned with the interests of shareholders.
This is such a valuable insight. It's a reminder to look for companies that are not only creating wealth, but also sharing it with their owners.
He also emphasized the importance of buying stocks at a discount to their intrinsic value, creating that margin of safety we discussed earlier.
Right, that buffer to protect us in case our calculations are off or the market takes an unexpected turn.
Precisely. And he believed that by being patient and disciplined, investors could find those bargain opportunities.
This is so inspiring. It's like becoming a treasure hunter searching for those hidden gems in the market. But let's be honest, the world of investing can be pretty intimidating, especially for beginners. What advice did Graham have for those just starting out?
Well, he believed that anyone could become an intelligent investor, regardless of their background or financial expertise. He stressed the importance of starting small, learning the basics, and gradually building up your knowledge and experience.
So it's okay to take baby steps and not try to become a Wall Street whiz overnight.
Absolutely. He believed that by starting small and learning as you go, you could build confidence and avoid making costly mistakes.
This is such a reassuring message. It's like learning to ride a bike. We start with training wheels and gradually gain the skills and confidence to ride on our own.
Exactly. And just like with riding a bike, the more you practice, the better you'll become.
I love that analogy, but even with practice, the market can still throw us some curveballs. What did Graham have to say about handling those unexpected events that can shake up the market?
He believed that investors should be prepared for the unexpected and be ready to adjust their strategies accordingly.
So it's like having a backup plan in case our original plan gets derailed.
Exactly. He encouraged investors to stay informed about current events and to be aware of the potential risks and opportunities that those events might present.
This is so important. It's like being a sailor, always scanning the horizon for potential storms or changes in the wind.
Exactly. And just like a skilled sailor, a skilled investor can navigate through those challenges and stay on course.
This is all starting to feel so much more manageable. But let's talk about something that can be a bit of a mystery, those investment funds that everyone's always talking about. I know Graham had some thoughts on mutual funds and ETFs, but where do we even begin with understanding those?
You're right, they can seem confusing at first, but Graham provided some guidance on how to approach them wisely.
Okay, all ears, break it down for me.
Well, he acknowledged that funds could be a convenient way to invest, especially for those who didn't have the time or expertise to manage their own portfolios.
So they're like pre-made meals for investors, easy and convenient.
You could say that, but Graham also stressed the importance of choosing funds carefully and understanding their potential drawbacks.
Okay, so what are the things we should be watching out for?
He was particularly wary of funds with high fees and expenses as these could eat into your returns.
So it's like ordering takeout, convenient, but it can get expensive if you do it too often.
Exactly. He also cautioned against investing in funds that were overly concentrated in a single sector or industry, as this could increase your risk.
So it's back to that idea of diversification, spreading our investments around.
Precisely. He also encouraged investors to look beyond a fund's past performance and to carefully scrutinize its investment strategy and the track record of its managers.
This is so helpful. It's like choosing a tour guide. We want someone who's experienced, knowledgeable, and has a plan for getting us where we want to go.
That's a great analogy. And remember, Graham believed that by doing our research and choosing wisely, we could find funds that aligned with our investment goals and helped us achieve our financial objectives.
This is such a valuable reminder to be discerning and not just jump into the first fund that sounds appealing.
Absolutely. And speaking of being discerning, Graham had some insightful thoughts on the importance of avoiding investment fads and scams.
No, that's a topic that's always relevant.
Yeah.
What were some of the red flags that Graham warned investors to watch out for?
Well, he was particularly skeptical of investments that promised quick riches or guaranteed returns.
So if it sounds too good to be true, it probably is.
Exactly. He believed that these were often scams or schemes designed to prey on unsuspecting investors.
So it's like with those late night infomercials, we need to be wary of those promises that sound too good to be true.
Precisely. He also cautioned against investing in companies with poor management, opaque financial reporting, or a lack of a clear business plan.
So it's about looking beyond the hype and really understanding what we're investing in.
Absolutely. He believed that by being skeptical and doing our due diligence, we could avoid falling prey to those investment traps.
This is so important. It's like being a detective looking for clues and piecing together the evidence before making a decision.
Exactly. And remember, Graham believed that by being informed, discerning and disciplined investors could protect themselves from those who sought to take advantage of them.
This is so empowering. It's like learning to defend ourselves in the financial jungle.
It is. Now, let's shift gears for a moment and talk about a concept that can be a bit intimidating, analyzing companies and figuring out what they're actually worth. I know Graham had a lot to say about this, but where do we even begin?
You're right. It can seem daunting, but I'm ready to tackle it. Where do we start?
Well, Graham emphasized the importance of understanding the business. What does the company do? Who are its customers? What are its competitive advantages?
So it's like getting to know a person before you decide to go on a date with them.
Exactly. You want to understand their personality, their values, and their long-term potential.
Got it. So we need to do our research and really understand what we're buying into, what's next.
Next, Graham said to look at the financials. He was particularly interested in a company's earnings, its assets, and its debt.
Okay, this is where I start to get a little lost. What are we looking for specifically in the financials?
Think of it like checking a car's engine before you buy it. You want to see if it's running smoothly, if it has any major problems, and if it's likely to last for the long haul with a company's financials. You're looking for signs of strength and stability. Are its earnings consistent? Does it have a healthy balance of assets and liabilities? Is its debt manageable?
This is starting to make more sense. So we're looking for those green flags that indicate a company is in good financial shape.
Exactly. And once you've analyzed the financials, you need to determine whether the company's stock is priced attractively. Remember, Graham was all about finding bargains, so he looked for stocks that were trading for less than their intrinsic value.
Okay, that intrinsic value concept, remind me how we go about figuring that out.
It can be complex, but Graham developed several techniques for estimating intrinsic value. He looked at a company's historical earnings, its assets, its growth prospects, and other factors to arrive at a reasonable estimate of what the business was truly worth.
So it's like being a detective, but instead of solving crimes, we're solving for value.
That's a great way to put it. And once you have an estimate of intrinsic value, you can compare it to the current market price of the stock. If the market price is significantly lower than your estimate of intrinsic value, then you might have found a bargain.
This is so fascinating. It's like finding those hidden treasures that everyone else has overlooked.
Exactly. And remember, Graham emphasized the importance of having a margin of safety. So even if your estimate of intrinsic value is slightly off, you're still protected.
This is such a valuable reminder to not overpay even for a great company. But let's talk about something that could be a bit scary: bear markets. What did Graham have to say about those periods when the market seems to be in free fall?
Well, Graham recognized that bear markets were an inevitable part of the market cycle. He believed that investors shouldn't panic during these downturns, but instead view them as opportunities to buy stocks at bargain prices.
So it's like with a clearance sale. The best deals are often found when everyone else is running for the exits.
Exactly. Graham believed that investors who were able to maintain their discipline and focus on the long term could actually benefit from bear markets.
This is so counterintuitive, but it makes sense. It's like remembering that a diamond is still a diamond, even if its price temporarily drops during a market panic.
Precisely. Now, speaking of diamonds in the rough, Graham had some fascinating insights into how to identify bargain stocks.
Okay, spill the secrets.
Yeah.
How do we find those hidden gems in the market?
Well, Graham believed that certain types of stocks were more likely to be undervalued than others. He was particularly interested in companies that were trading below their net working capital.
Wow, that sounds like a steal. What does that mean exactly?
It means that the market was essentially valuing the company at less than the sum of its liquid assets, as if the rest of the business, its operations brand, and future earnings potential were worthless.
That's wild. So it's like getting the entire business for free just because the market is temporarily undervaluing it.
You could say that, of course, it takes careful analysis to determine whether such companies are truly undervalued or if there are underlying problems. But Graham believed that these situations often presented compelling investment opportunities.
This is so fascinating. It's like being a financial archaeologist, digging up those hidden treasures that everyone else has missed.
Exactly. Now, while we're talking about Graham's ideas, there's one more thing we should mention. He had some strong opinions about investment funds.
You mean mutual funds and ETFs? I'm curious to hear what he thought about those.
Well, he recognized that they could be a convenient way to invest, particularly for those who didn't have the time or expertise to manage their own portfolios. However, he was also wary of the fees that some funds charged, and he believed that investors needed to carefully scrutinize a fund's track record, its investment strategy, and its expense ratio before investing.
So like with anything else, buyer beware.
Exactly. He stressed the importance of choosing funds wisely and understanding how their fees and expenses could impact returns.
This is such a valuable reminder to not just blindly jump into a fund because it sounds good. We need to do our homework and make sure it aligns with our investment goals and risk tolerance.
Yeah, absolutely.
Okay. So funds are like anything else. Yeah. Got to be careful.
Do your research.
Do your research.
Yeah.
Okay. This has been such an eye-opening conversation, I feel like,
Good.
I'm starting to see the world of investing through like a whole new lens.
That's great.
Yeah. But even with, all this newfound knowledge,
Yeah,
I can't help but feel a little overwhelmed.
I get it.
There's so much to learn.
It's a lot.
Yeah.
It is. But remember what we talked about.
Yeah.
Graham emphasized that becoming an intelligent investor is a journey, not a race.
Okay, so it's okay to take it slow
Take it slow.
and learn as we go.
Yeah.
Okay. What about all those different investment strategies out there?
Yeah.
There's like value investing, growth investing, momentum investing.
There's a lot.
It's enough to make your head spin. Did Graham have any thoughts on, which strategy was the best?
Well, you probably already know the answer to this, but Graham was a big advocate for value investing.
Okay.
He believed that by focusing on the fundamentals and buying assets for less than their worth,
Okay.
investors could achieve consistent long-term returns.
Okay.
But he also recognized that other strategies could work,
Okay.
depending on the individual's goals,
Okay.
risk tolerance, and time horizon.
So it's like choosing a travel destination.
Yeah,
There's no one right answer.
exactly.
Depends on your circumstances.
Yes, exactly.
Okay, I like that.
Find a strategy that you're comfortable with and that fits your financial plan.
Okay. So we kind of have a map,
Yeah,
but we still need to know how to read it.
absolutely.
Right. What advice did Graham have for those of us who are still, like,
Yeah.
learning the language of investing?
He was a big believer in education.
Okay.
He encouraged investors to read books, attend seminars, talk to other experienced investors.
So it's like learning any new skill.
Exactly.
You got to, put in the time.
You have to. You
Yeah.
have to.
Hey.
And the more you learn, the better equipped you'll be to navigate those complexities of the market and make those sound decisions.
Totally. But the world of investing is like constantly changing, right?
Always.
So how do we like stay ahead of the curve and adapt to those
You
changes?
got to be flexible. You got to be adaptable,
Okay.
right? He recognized that the market was constantly evolving and that investors needed to adjust their strategies as needed.
So it's like being a surfer,
Yes,
learning to ride the waves as they come.
exactly. You got to stay informed about economic trends, industry developments, those technological advancements.
It's curious. Keep learning.
Yes,
But with so much information out there,
right.
how do we filter out like the noise
Yeah.
and find the signal?
Focus on the fundamentals.
Okay.
He encouraged investors to avoid getting caught up in all the hype or those short-term fluctuations and instead focus on the long-term value.
Okay. So true value endures,
Yes,
even when,
it does.
the market's like
Yes.
having a mood swing.
Focus on the things that matter.
Okay.
The company's earnings, their assets, the management, their long-term prospects, and you'll be able to make much more informed and rational decisions.
Okay. That makes sense. But investing can be like an emotional roller coaster, right?
It is.
How do we stay grounded and avoid letting fear and greed get the best of us?
Even the most experienced investors struggle with this. But what I would say is have that plan.
Okay.
Stick to your plan, be patient, and that'll help you stay the course.
So it's like having a map and a compass.
Exactly. Remember your long-term goals and avoid making those impulsive decisions.
Yeah, eyes on the prize.
Exactly.
But even with, the best intentions,
Yeah.
we're bound to make mistakes along the way.
Yeah.
What did Graham have to say about, learning from our investment blunders?
He believed mistakes were inevitable. It's part of the process. Analyze your mistakes. Understand why they happened. And use those insights to make better decisions going forward.
So it's like with any other skill,
Yeah.
you learn from your mistakes.
Exactly. He didn't see them as failures, but as opportunities for growth.
Okay. Well, this has been an incredible journey through the world of Benjamin Graham.
It has been.
I feel like I've gained like a whole new perspective on investing.
I'm so glad. Remember, the journey of becoming an intelligent investor is ongoing. Keep learning, stay curious,
Okay.
and always remember the wisdom of Benjamin Graham.
Excellent advice. Thanks for, sharing your expertise with us today.
Of course.
And to you, dear listener, remember that the power to become an intelligent investor lies within you. Now go forth and invest wisely.
Yes.